You know that $100 that just kind of vanishes from your checking account between the 1st and the 15th of every month? It doesn't really leave a traceable explanation, right? It goes to some dinner out you don't even remember, a subscription you literally forgot existed, or just a bunch of small random transactions that somehow perfectly add up to $100. But it really begs the question, what actually happens when that $100 goes somewhere intentional instead? Like, what happens when you give it a real compounding purpose?
Well, welcome to today's Explainer. We're going to unpack the absolutely incredible journey of a small monthly contribution. And honestly, it's fascinating to look at because we aren't just talking about math today. The math, well, especially in the early years, is actually a lot slower and way less impressive than the internet might have you believe. Instead, this explainer is really about discovering how that very first intentional, consistent $100 investment fundamentally alters your financial identity. It completely changes what you prioritize, what you notice, and literally the category of person you're operating as. Because the $100 actually isn't the point. With $100 starts, that's the whole shebang.
So, here is our roadmap for this 30-year journey. First, we'll look at the $100 identity shift. Then, month 6, which is your first real test. Next up, years 1 and 5. After that, the machine takes over, and finally, we'll look at 30 full years of compounding.
All right, part 1, the $100 identity shift. Let's dive right into how this whole thing starts. The actual mechanics of getting started, they are remarkably simple. Picture this. You sit down on a random Tuesday evening and you just follow these 5 steps. You open an account at a brokerage, think Fidelity, Vanguard, or Schwab. You link your checking account. You set up a completely automatic transfer of $100 on the first of every single month. You select a total market index fund, something like VTI or SWTSX. You confirm the purchase and then you just close the app. That's it. That is the entire action. It takes what, maybe 20 minutes? Just one decision and one automation.
Now, the next morning, you wake up and your life looks absolutely identical to the morning before. Your coffee tastes the exact same, your commute takes the exact same amount of time, and your account just says $100 sitting in it. It doesn't really feel any different. But make no mistake, what just happened wasn't just some financial transaction. It was a complete category transfer. See, before last night, you were someone who intended to invest someday. But after last night, you are someone who invests. And behavioral research shows that the single most reliable predictor of continued investment behavior is literally just having started. You cross that threshold, and those two people, they arrive at very, very different places 20 years down the road.
Okay, moving on to part 2. Month 6, the first test. Let's look at exactly where your nervous system is going to face its first real challenge. Imagine the market drops, say, 8% in just 3 weeks. Suddenly, the $600 in contributions you've been so diligently making over the last half year, it's now showing a balance of about $563. Yep, you've lost $37 on paper. Now, your nervous system actually evolved to avoid getting eaten by saber-toothed tigers, right? So it treats this tiny $37 paper loss as literal physical danger. It registers the drop with this wildly disproportionate, panicky response. And this is your very first test. The thing is, passing this test doesn't require any sort of financial sophistication. What it tests is your ability to do absolutely nothing, right? When doing nothing feels completely wrong. The people who actually pass this test look at that $563 balance, they remind themselves, hey, I don't need this money for another 30 years, and they just close the app. They correctly identify that their job at this stage is not to optimize. It is simply to not interfere. But if you fail this test, you fall victim to a really devastating behavioral friction. See, people who panic sell their positions, they usually move to cash and wait for the quote-unquote right moment to get back in. But here's the kicker. The right moment never actually arrives with a clear, obvious signal. Just look at the data from JP Morgan. Missing just the 10 best trading days between 2003 and 2023 literally cuts your returns in half. And guess what? Most of those 10 best days happen in the 2 weeks immediately following the worst days. So the people sitting in cash waiting for stability, they completely miss the recovery that starts while the news still looks terrible. When your balance drops, closing the app and doing nothing is literally the only right answer.
All right, part 3, years 1 and 5. Let's see what happens as we push a bit further into the future.
Let's take a look at year 1. You've contributed $1,200. Now, assuming a pretty standard 7% annual average return, you've made about $47 beyond your actual contributions. Yep, just $47. From the outside, the cost of a decent dinner out seems like a pretty underwhelming return on a whole year of disciplined investing, right? But from the inside, Man, it is absolute proof that you are building a rate, not just a balance. Because of that larger base, that $47 jumps to $94 next year on the exact same contributions, and then $145 the year after that.
And alongside that growing rate, something even more profound is happening to your identity. Your financial awareness is expanding outward. Because you're now someone who actually tracks returns, you start seeing costs entirely differently. Suddenly, you notice that the expense ratio in your 401k fund is a whopping 1.2%, especially when there's a comparable option charging just 0.03%. You realize your credit card interest rate is basically canceling out your investment returns every single month you carry a balance. You finally spot that $180 annual subscription that you literally only use twice a year. This new awareness, it just ripples through your entire life.
Fast forward to year 5. With 60 months of contributions totaling $6,000, your balance is sitting at roughly $7,200. The compounding is finally becoming visible. Your return is now 20% of your total balance. But even more impressively, your money is now independently generating $42 a month, just by existing. Almost half of your monthly contribution is being produced without any effort on your part whatsoever.
But year 5 comes with a massive, flashing behavioral warning sign. This is when lifestyle inflation is absolutely at its most dangerous. Your income is probably higher by now, and that $100 transfer, it feels routine. Maybe it even feels a little too small to matter. The voice in your head might start telling you that pausing your contributions for just 1 year won't really hurt. But listen to this. If you carelessly pause contributions for 3 years right now, you aren't just losing $3,600 in deposits. You are losing the compounding on them for the next 20 years. That is a $19,000 mistake. So whatever you do, don't pause it. Actually, if anything, increase it.
Which brings us to part 4. The machine takes over. Because as we hit years 10 and 20, the mathematical pacing accelerates dramatically.
Let's look at year 10. You've put in $12,000 over the decade, and your balance is around $17,400. It is wild to look at this split. The market did 45% of the work this year, generating $5,400 in returns. You did 55%. You are marching right toward this magical crossover point, which usually happens around year 12 or 13, where your annual return will officially exceed your annual contribution. And by this point, investing isn't really a discipline anymore. It's just your default. Honestly, stopping would feel like an anomaly.
And here is where the ultimate power shift happens at year 20. You have contributed $24,000, but the market has generated $28,000. For the very first time, your money has made more money than you actually put in. Your total balance is roughly $52,000. The math has completely turned. You are a self-sustaining system now. You're no longer the engine of your wealth, you're the steward. That person who couldn't imagine $100 becoming anything 20 years ago, they are genuinely unrecognizable now.
Finally, part 5. 30 years of compounding? Let's look at the grand finale. At year 30, you've reliably contributed your $100 every single month without interruption. That totals $36,000 out of your pocket. But look at the market returns, $85,000. Your total balance is approximately $121,000. It is honestly incredible to think that for every single dollar you put in over those 3 decades, the market added $2.36. This massive payout came from one single 20-minute decision made on a Tuesday evening that felt almost too small to even matter at the time.
And of course, you can scale this up. $200 a month becomes $243,000. $500 a month becomes over $600,000. But you know what? The variable that matters most in all these numbers is not the monthly amount. The secret ingredient is the 30 years of uninterrupted time. Compounding needs time the exact same way a fire needs oxygen. It just simply doesn't work without it. The person who starts at 25 with $100 will arrive at 55 in a fundamentally different and honestly often better financial position than someone who starts a decade later with 3 times the money. The lost decade actually costs way more than the contribution.
What this whole journey really provides is a financial education that actually pays you to attend. By keeping real money in a real account, doing real things, you learn how money works better than any amount of internet content consumption could ever teach you. The anxiety of checking your banking app in the middle of the night, that shifts from fear to curiosity. You aren't checking to confirm you're standing still anymore, you're checking to watch your money grow. The $100 you invest this month will not change your life this month, but it absolutely will change the person making the financial decisions next month and the month after that.
That future version of you, 30 years from now, will have built a financial fortress that the person sitting on the couch tonight cannot even picture yet. So I'm going to leave you with this one final provocative question to think about. What is actually stopping you from taking 20 minutes tonight to set up that automatic transfer? Thank you so much for exploring this with me today, and I'll catch you in the next explainer.